Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome, everyone, to another exciting episode of Tax Smarts Unlocked. I'm your host, David Robson, and today we're diving into the intricate world of retirement contributions for business owners. Whether you're a seasoned entrepreneur or just starting your small business journey, understanding how to maximize your retirement contributions while minimizing tax liability can be a game changer for your financial future. Retirement may seem like a far-off dream, but the steps you take today will set the stage for your future financial stability. So stick around as we unpack this complex yet rewarding topic with a splash of humor to keep things light. Let's kick off with an overview of the retirement contribution options available for business owners. Now, unlike employees who primarily rely on their employer's retirement plans, business owners have a plethora of options to choose from. You've got traditional 401k, solo 401k, for the self-employed SEP IRA, simple IRA, and more. Each of these options comes with its own contribution limits and tax advantages. The key is to understand how these plans fit into your overall tax strategy and to make sure you're making the most of them. Speaking of contribution limits, it's crucial to know how much you can contribute to each type of account. For instance, in 2024, the contribution limit for a solo 401k is up to $69,000 if you're under 50, and up to $76,500 if you're 50 or older, due to the catch-up contributions. Compare that to an IRA, which caps out at $7,000 or $8,000 with a catch-up contribution if you're over 50. The SEP IRA, on the other hand, lets you contribute up to 25% of your net earnings from self-employment, up to a maximum of $69,000. Understanding these limits helps you make informed decisions about where to put your money for the most tax advantage. Now let's explore strategies specifically for self-employed individuals to maximize their contributions. Since you wear both the employee and employer hats, you can potentially double dip. In a solo 401k, for example, you can contribute both as an employee and then as the employer. First, there's the elective deferral up to $23,000, then the employer contribution up to 25% of your net earnings. This double contribution power is something salaried employees can only dream of. But why exactly are retirement accounts such great vehicles for tax savings? Most retirement contributions reduce your taxable income for the year you make them. For example, if you make $100,000 and contribute $20,000 to your solo 401k, your taxable income for the year is only $80,000. Imagine the tax savings. Moreover, these accounts often come with tax deferrals, meaning you won't pay taxes on the earnings until you withdraw them in retirement. Or if you opt for something like a Roth IRA, you pay taxes now, but enjoy tax-free withdrawals later. Tax planning is not just about saving money today, but setting yourself up for a better financial future. Timing is another critical aspect of tax planning with retirement contributions. Contributions to accounts like a SEP IRA can be made up until your tax filing deadline, giving you extra time to manage your cash flow and make informed decisions. In other cases, such as with 401k plans, it's usually best to make contributions throughout the year for cash flow management. Timing can affect your current year's tax liabilities tremendously, so it's not just how much you contribute, but when. Next, let's look at some case studies that illustrate effective retirement contribution strategies. Here's a scenario. Jane runs a small advertising agency, and she had a great year, netting $200,000. If she maximizes her solo 401k contributions, she could potentially save over $25,000 in taxes. How? By maxing out her contributions as both employee and employer, she reduces her taxable income substantially and takes full advantage of the present tax laws. Another example can be seen in Joe's scenario, a freelance writer with variable income. He prefers the SEP IRA due to its flexibility and contribution timing, allowing him to make smart deposits based on his income fluctuations. Common mistakes can unfortunately undo some of these smart strategies. One of the major ones is not contributing enough to get any matching contributions from your plan, a missing out if you're using a solo 401k. Another frequent error is over-contributing and facing penalties. Keep track of contribution limits, and if you end up over the edge, correct it promptly to avoid IRS penalties. Also, ignorance of Roth options can lead to missed opportunities for tax-free growth. Being aware of these pitfalls ensures you not only maximize contributions, but also keep more money in your pocket. To truly integrate retirement planning with your overall financial goals, consider working closely with a financial advisor or tax professional. They can help tailor a strategy that's specific to your business and personal objectives. Retirement accounts should be an integral part of your financial plan, not just a side thought. This involves coordinating with your cash flow needs, future expenses, and even estate planning if needed. Making these connections can secure a more stable and prosperous financial future. Managing and tracking your retirement contributions can be daunting, but thankfully, there are resources available. Many financial services offer online dashboards that allow you to track your contributions, growth, and returns. Additionally, using accounting software that integrates with these financial tools can streamline the process significantly. Make sure you have a reliable system in place to ensure you're not missing out on maximizing your contributions each year. Before I wrap up, let's take a moment for some final thoughts. Proactive tax planning isn't just about finding ways to lower your tax bill. It's about empowering yourself to make decisions that will benefit you both now and in your retirement years. Being informed and staying up to date with the latest in tax laws and retirement planning options will give you the upper hand in securing your financial future. So keep learning, stay proactive, and most importantly, make the tax laws work for you. That brings us to the end of today's episode of Tax Smarts Unlocked. I hope you found our discussion on maximizing retirement contributions as enlightening as it was educational. We've covered a lot of ground today, from understanding various retirement plan options to maximizing your contributions and leveraging tax benefits, all while giving you practical strategies to avoid pitfalls. Remember, proactive planning is your ally in building a financially secure future. If you enjoyed this episode, don't forget to subscribe and share it with fellow business owners who might find this valuable. Thanks for tuning in, and until next time, keep unlocking those tax smarts.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.